hey, this is a great housing market. I'm making a lot of money on my housing. Nobody is really thinking about this as something that collapsed, which is almost always the case. But then what we get to is there's some point in time where something in the dynamics of the market becomes pushed so far away of sustainable fundamental factors, which here the biggest thing would be the ability of people to afford the interest payments on the loans that they had undertaken to buy homes.
Join the best in the movement. It's Conservative Conversations with ISI, educating for liberty since 1953.
All right. Welcome back. You're listening to Conservative Conversations with Tom Sarrouf, and very, very excited for this episode with my guest, Todd Sheets. Todd graduated with honors from the University of Iowa and won the prestigious Elijah Watt-Sells Award on the 1981 CPA exam before embarking on a career in investment banking. In the late 1980s, he initiated and led Raymond James Financial's Recovering Markets program that bought undervalued apartment properties in distressed markets. All of those properties were later sold at a profit to the firm's investors. In the early 1990s, he founded and served as managing director for Raymond James's highly regarded public real estate's investment banking practice before retiring to devote himself to long-held interests in investing, writing, and economic history, which produced this book, 2008, What Really Happened, Understanding the Great Financial Crisis, which is forthcoming from Encounter Books. So Todd, congratulations on the book. Thank you for joining me.
Thanks for having me. I'm delighted to be here.
Yeah, you have this very impressive resume, and as a sort of insider in this world, and we're talking about the housing crisis in 2008 and how it led to this larger conflagration in the stock market and the wider economy. But before we dive into all the details, could you start by telling us how you came to write this book and be interested in this topic, but also why now we need a book about what happened in 2008 and 2024?
Sure, I'd be happy to. This kind of came about a little bit as a matter of happenstance. I retired from investment banking thinking I wanted to start an investment firm, and circumstances, went very well. But then we got into the tech stock collapse in the early 2000s, which I was well protected from an investment standpoint. But what ended up happening was all the stocks I was the part of the market I was very interested in kind of shot up when money moved out of the tech stocks. And then the Fed started lowering interest rates to try and counter impact what was happening with the tech stocks, and help the economy ride through that. But I became very concerned that, these ultra low interest rate policies were going to end up badly. So I decided to just take some time and kind of, wait a little while to see how all this unfolded. And as I was doing that, I kind of had the realization for the first time ever that if I wanted to do something other than just start a business or stay on the path of my business career, that option was available to me. So I started down the path of writing when my oldest son went off to college. I started with a novel that I had in mind. And then the financial crisis came. And that was kind of like the fruition of the things that I had started to worry about in the early 2000s. And I thought, well, this is going to be this big implosion, which it came close to being, and in part was. But then as that all started to unfold, what we saw was the Fed, the Treasury, and the various federal authorities taking measures to support the economy that went way beyond anything that they had ever done before. Bailing out investment banks, Bear Stearns was the first one, was a historic step for them. And I started to feel like the economic model that I had grown up with and kind of taken for granted all of my business career was changing dramatically in ways that I had never anticipated. And I was kind of disoriented by that. And at one point, I remember remarking to one of my children, I think what I need to do is I need to dig into this a little deeper. And so that basically started a multi-year study of investment history that I became very much enthralled with. And ultimately, a friend of mine, I was telling him some of the things that I was learning, and he says, geez, you got to write this up as an editorial or something. And it kind of hit me in that moment. It was one of those aha moments. I thought, well, I think this is going to be a book. And so I decided, I went down a couple different paths, first thinking about maybe writing an economic history of the country. And then I said, okay, this is too much to start off with on the first book. I need to narrow the focus, and let's focus in on the great financial crisis. And so then that was the beginning then of working on the book that you just held up.
Hey there, listener. I wanted to take a quick moment to thank you for listening to Conservative Conversations. This podcast is a production of the Intercollegiate Studies Institute, and our mission here at ISI is educating for liberty. If you'd like to join us in fulfilling our mission, consider helping us by rating and reviewing this podcast on Apple Podcasts, Spotify, or wherever you listen to help us reach more listeners like yourself. Now, back to the show. Well, let me say, I'm very glad that you wrote this book because, and specifically on the great financial crisis, because I would have been like 7 years old when this whole thing kicked off. So too young to understand what was happening both economically and politically, and no one explained it to me. So basically the 2008 financial crisis has been a big black hole in my understanding of American politics, economics, and our history. And this book, I think, is very great in terms of not only what caused the Great Recession and what the lead up to it and why, but also sort of the underlying market fundamentals of maybe like macroeconomics or financial and investment banking, which I don't really understand at any level. So forgive me as I probably ask a lot of stupid questions. But maybe you could actually help us by orienting us to what the housing and mortgage markets would look like, at least in theory, in terms of the different pieces of that relationship in normal conditions, apart from or prior to what happened with the creation of the bubble and then the crash.
Yeah, so that's a great, predictable and reliable housing market. And there's data that goes back on the national housing market that's been compiled by Yale's Robert Shiller, very highly respected, that goes back to the late 1800s. And so as I started getting into this and looking at this, I mean, one, I knew from a personal standpoint, the housing markets have always been reliable. They've always been thought to be kind of a cornerstone of building a family or a person's net worth, because it's a predictable, stable source of growth in value for in families and investors. And we had never really had anything like a national housing boom and bust throughout the history of the country up until what started to happen in the late 1990s. And that was, in fact, one of the reasons why this whole event kind of caught the investment community, the economics community, and the home buying community, almost every level of the participation in it, so off guard. It was generally considered, not just by lay people, but also by financial and economic people, that a national housing boom or bust was something that just wouldn't happen. It wasn't in all the historical models that were used to understand this. And housing was thought to be a local or regional kind of phenomenon. So you might, in an area like, early in my career, I mentioned in the book, or you mentioned in the resume, I was involved in buying properties in the Southwest. Well, that was after a real estate bust that happened out there. That was a very localized and regionalized situation that was tied into the collapse of the oil economy in the 1980s, and then the collapse of the savings and loan industry, which specifically hit that area very hard. So local, regionally, yes, but nationally, no. And so you can go back and look at the statistics, and as we talk about in the book, housing basically grew at the rate of inflation for 100+ years leading up to the late 90s. And there were some times over that period, like the Great Depression or during the 1980s, when it might move off trend for a little while, but then it always reverted to that trend line of general inflation, within a relatively short period of time, until, as you suggested, we get to the late 1990s, when all of a sudden we see this significant divergence that leads into the housing bubble, and then the housing bubble puts us in a position where there's the potential for a financial panic. So, yes.
Then I think that begs the question, what changed?
Yeah, so that's the perfect question, actually.
The story of the whole book.
Yeah, exactly. So that's one of the things that I focus on very closely in the book, is that it's very important to step back when anything like this happens. That there's some sense, I think, generally, it's one I probably had as a child. I didn't grow up in a academic or economic kind of household, or even a business household. So I just had a general sense of these things. But sometimes there's a general sense that our economy is prone to major panic or catastrophic type events. The fact of the matter is it's not. This is really the first one of anywhere near this magnitude that we had had since the Great Depression. And although there had been some significant downturns prior to the Depression, there hadn't been anything like that for over 100 years. So these are very, very rare events. And so whenever you come into a situation like this, as I put it in the book, whenever markets have worked as well as they had, for example, in housing for so long, without causing a major catastrophic event, you have to start with the question that you just asked, which is, what suddenly changed? And the big thing that changed in this particular situation was what are commonly referred to in the investment community as the GSEs, or the government-sponsored enterprises, Fannie Mae and Freddie Mac. And so if you think it's worthwhile, would you think it's worthwhile to give a little background on that?
Yeah, what are the GSEs? How do they come into existence? How do they basically work in the housing and mortgage market?
Yeah, so the GSEs, basically, there was one of them. Fannie Mae was formed in the New Deal legislation of the 1930s amidst the chaos and confusion of the Great Depression, which was not well understood at the time or for many years afterward, as I pointed out in the book. It was at the time thought of as an incidence of significant private market failure and the need for a much more activist government role to be taken. So one of the things that happened among the smorgasbord of programs that were rolled out by FDR and the New Deal administration was the creation of Fannie Mae, which was designed to play some role in providing financing to the housing markets. But nonetheless, Fannie Mae remained an insignificant part of housing finance in the decades that followed. And interestingly, as I pointed out in the book, this didn't keep the housing markets, the lack of a government or federally government-oriented institution did not keep the housing markets from growing rapidly during those years and those decades, as was evidenced by what many people know of as the post-war housing boom. And in fact, mortgage growth, which was primarily coming from savings and loans and banks at that point in time, grew at about 10% a year from the 30s all the way up into the 60s, which was significantly faster than the economy as a whole. What started to happen in the 1960s is that the banking regulatory model that was also erected back in the 1930s, along with deposit insurance, started to experience some problems, because that model was very restrictive in terms of branch banking, where a bank could make loans, where it could take deposits from, all those kinds of things. And what started to happen by the 1960s is significant growth in areas like California and Florida left those markets short of housing funds, while areas that weren't growing as rapidly, such as the Northeast or the Midwest, but were also large concentrations of wealth and savings, kind of had an abundance or an excess of housing funds. And because of the inability of that banking regulatory model to adapt to those changing needs, housing needs, we had money tied up in areas that couldn't get to the areas where people needed it. Well, obviously, with the number of voters moving to Florida and to California, as I say in the book, this was no mere matter of high finance. This was a very important political issue. So Washington wanted to try and do something to resolve this problem. One of the options would have been to deregulate the industry in a manner that was similar to what started during the Carter administration and was continued in the Reagan administration in many areas of the economy with great success, although not always with great success. One exception was the savings and loan industry in the 80s. But had it been deregulated so that money could flow more freely around in a thoughtful way, that would have been the ideal solution, in my opinion. But instead, this was during LBJ's Great Society years, which was, LBJ's hero was FDR, and the Great Society was like a second expansion of the New Deal activism in the economy. And so what they did was they decided to take Fannie Mae, but instead of using it directly as a part of the federal government, where they would have had to take Fannie Mae's debts onto the books of the federal government, they decided to move it outside of the federal government. The reason for that was because LBJ's, what was at the time called guns and butter spending, there was a vast escalation of the Vietnam War under his administration, and then also the rollout of the Great Society social programs, which were causing significant funding issues to begin with. These are the things that later led to the inflation of the 70s. But to deal with the housing issue, they took Fannie Mae, moved it off the government books, and turned it into a private corporation, which meant it was owned by private shareholders, with its stock traded on the New York Stock Exchange. But they gave it special government privileges because they wanted to continue to be able to influence the housing markets. Now, what happened was, so if we go back to the late 60s when Fannie Mae was moved off the books, and then Freddie Mac, the second of these two institutions, which was formed in 70 or the early 70s to provide a competitor, but basically the same model. If we go back to that point in time, Fannie and Freddie combined represented well below 6% of the total mortgage market. So they didn't have any ability to influence what was happening with housing. But they had these special government privileges, which were kind of designed to send a message to the market that these aren't just regular private entities. These are entities that the federal government cares a great deal about. And if they ever get into deep trouble, you probably can count on us, the federal government, to step in and resolve those problems. What that did was it gave Fannie and Freddie a funding advantage in the marketplace. So the way any lender works is they borrow money from others, and then they lend that money out. And if you can borrow money at a lower cost than all of your competitors can borrow, because you have this implied government backing, that gives you a cost of funds advantage, which almost guarantees that you're going to grow and grow over time. And that's exactly what happened. Fannie Mae and Freddie Mac gradually grew and grew and grew over the decades from the late 60s up to the late 90s. And I think this was the first major point that was kind of missed by people in the marketplace. By the mid to late 1990s, they got to the point where they represented 40% of the national housing markets. So all of a sudden now, you would ask the question, what changed? What changed is, instead of having housing provided by a broad array of savings and loans and banks and a small number of other institutions, all of a sudden we had these two, as I call them in the book, 800-pound gorillas who were thrashing around in the basement of the national housing markets, and who had the ability to impact those markets nationally if they chose to do so. And in 1998, that's exactly what happened.
Okay, so then if I'm a government-sponsored enterprise, so if I'm Fannie or Freddie, basically what that means is if I want to buy a home, instead of going to a bank, I would go to this company to get money for a house.
Yeah, or they worked in partnership with some other lending institutions, or they would guarantee things or whatever. But your source of funding, you're buying a home, and your agent is going to recommend to you an underwriter, or somebody who works with Fannie and Freddie, because they have these special privileges. They can borrow cheaper than the local savings and loan can. And as a result of that, they pass some of that benefit on to you in the form of a lower cost mortgage than the other competitors can provide. And so you choose to go with them. And this is happening over and over again until, and their share of the market is growing and growing until all of a sudden we get to the late 90s and they've got 40% of the market, and they have the ability to basically drive housing on a national basis.
Okay, good. I follow you. So then you were talking, before we got onto that explainer, you were talking about what changed. So I think we're kind of getting into what you call the liftoff of the bubble. So
Yeah.
please, that's what we were talking about before we went on this helpful tangent. So please continue.
Yeah, so the liftoff, I think the first key, and one of the first things I go through in the book in understanding the bubble, I referenced the data that was prepared by Robert Shiller at Yale earlier. The first key step, I think, was when I went back, I took that data, which was monthly data after the mid to late 1940s, turned it into annualized data, and then tracked that going back throughout history, which basically shows what we talked about earlier, is housing prices, trend with inflation. And then I tracked it annually, beginning, from the 40s forward, but especially looking at this period of time beginning in the late 1990s and up through the mid 2000s to see what was happening with housing. And when we do that, what we find is that housing prices in the 4 years leading up to the onset of the bubble started in 1998. In the 4 years prior to that, which I call the base period, housing prices tracked almost right on with general inflation, as they had done historically. But then in 1998, we have this significant and sudden departure, where instead of tracking with inflation, all of a sudden we see housing prices moving at 4 percentage points, or what in the industry you would call 400 basis points, over the rate of inflation. And this is like a 1-year move. I think in 1996, they were down, housing prices were down a little relative to inflation. In 97, they were up by like 0.7%. And then the next year, in 98, all of a sudden, housing prices are up 4%. And they basically stay there for each of the 4 years of the liftoff period. I think over the liftoff period, housing price appreciation runs at an average of like 4.7%. So what we know now, when we see that, is we know something happened that was sudden and dramatic and sustained. And so any explanation of what happened has to be consistent with those data points, which, for example, one of the things, if you don't mind going off for just a second, I think one of the most predominant theories of the crisis that has been out since it occurred has kind of been the gradual deregulation narrative. This was the idea that we had a crisis because we went through this gradual deregulation trend that I talked about earlier, starting with Carter and Reagan, that it went too far and there wasn't any specific event that triggered anything, but this was happening gradually over this long course of time, and eventually it spun out of control into a housing bust and a financial panic. But if that had been the case, we wouldn't see this very clear liftoff from the historical trend in 1998, and then this being sustained, and then significant turning points thereafter as well. So we go back to 1998, all of a sudden housing prices shoot up and they stay at this level for 4 years. Well, this brings us back around to the GSEs that we were just talking about. The next thing that we did was I went through and tracked what was happening with the GSEs and their portfolios. And what we find is that also in 1998, there is a sudden and significant acceleration in what the GSEs call their total book of business, which is all of the housing, single family housing loans that they're responsible for. So prior to 98, in the 4 years before, when housing prices were tracking with the history, the GSEs were growing by about 7% a year. In 1998, they grow by 16% a year. And that rapid acceleration of their growth rate is also sustained for the next 4 years. It moves around a little bit, but on average, they grow at, I think, over 15% slightly for the next 4-year period of time. So we see this perfect correlation between this obviously intentional expansion of the GSE's mission to try and push more money out into the housing markets. And, they were trying to help people buy homes, be able to participate in the American dream and benefit from the things we talked about earlier, which was this long period of building wealth through the ownership of housing. And, their mission was supposedly focused on low and intermediate income home buyers. So all of a sudden, with the blessing of their federal overseers and their regulators, they go through a major expansionary program, and that's what drives the liftoff of the housing bubble.
Okay, that makes sense as you explained it. But why are they doing this? Is it because are they just trying to be helpful and get more people into homes? Is there a law that's passed? Are people trying to buy more homes and they're responding to that?
Yeah, I think they decided, and they got their federal overseers to agree, because we can also track, they have lending limits on the size of homes that they can loan money to, which is designed to keep them focused on that low and moderate income home buyer market. And what we see also beginning in 1998, at the same time that their expansion takes place, is a significant increase in the pace of conforming loans for them. All of a sudden, the government is giving them the ability to provide loans to at higher and higher levels. And so I think what we clearly see, although I haven't come across any specifics, but somewhere along in that period of time, the GSEs probably decided that they wanted to make a significantly larger push into the housing markets than they had made before. They wanted to grow significantly faster than they had in the past. They went to their overseers in Congress, convinced them that this would be a good idea and a good thing, and they got their approval, which we can see by tracking these conforming loan limits that they operate under. And so, they go through a major expansion. I'm convinced, Franklin Raines was the head of Fannie Mae at that time. He's a very interesting story. He came from a low-income family. His dad built their family home, with his own hands over about a 5-year period of time. And, I heard him at the time, read other articles about him where he talked about how critical that was for his family to be able to build wealth coming out of a lower income kind of environment. So I'm convinced, he pushed down this path with good intentions, and as did the administration and Congress. But nevertheless, what they did was they kicked off the beginning of the housing bubble. They are the ones that all of a sudden by pushing more money out into the marketplace, they were providing the financing that was there to encourage people to buy homes. And that's what then triggered this acceleration of home prices that we see beginning in 1998, which then ran for a 4-year period of time, 1998, 1999, 2000, and 2001 is the liftoff period.
Okay, yeah, so they're able to give more money to more people and increase this lending limit, and that allows more and more people to get involved in the market, and that starts to drive up prices beyond what would normally be the case by the historical models.
Exactly. They're intervening in the markets is really what's happening. I guess to put it in a nutshell, they're trying to expand their mission of expanding home ownership throughout the United States. And as they do this in a significant way, after they've accumulated such large market shares, what they start to do for the first time is they actually become the driver, as I say in the book. They become, they're sitting in the driver's seat of what is happening with the national housing prices.
And that's because of their wide market share.
Because they had become such big players. If that had happened 30, 40 years earlier, it wouldn't have led to the same thing because they weren't a big enough part of the system. But, to put these things in perspective, in the order you asked the questions, which was right, what was the thing that changed? They had reached this point where they had this huge market share and the ability to drive national home prices. And then they went on this mission to expand homeownership. And the two of those things coincided at a point in time where they actually then drove a substantially higher rate of housing appreciation than had ever happened in the markets before.
All right, this is a great explainer. I'm understanding. Then let's continue to what you call the second phase of the bubble, which is the acceleration phase. What is the change between the liftoff, which you just described, and acceleration?
Yeah, so the acceleration phase begins from 2002 and runs through 2005, also a 4-year period because it's inclusive of those years. And what happens as we get to the early 2000s is Fannie and Freddie begin to experience some regulatory issues related to their accounting. That slows their growth rate down a little bit, not substantially, but they're not growing fast enough to continue to be the driver of what happens during this acceleration phase from 2002 to 2005, which we probably should start off, and I should say what happened there. During the liftoff phase, as I mentioned, housing prices grew by about 4.7 percentage points per year over inflation, historic highs. Then during liftoff, what happens is the rate of acceleration goes up and it actually averages over 8% for the 4 years of liftoff. So we have a historic rise during liftoff, and then during acceleration, it goes up by about another 75%. The rate of appreciation doesn't quite double relative to liftoff, but almost. So again, a huge discrete turning point. And this happens all through it. And actually, we end up with a 10 percentage point increase in the last year of the liftoff, which is higher in that 1 year than what had happened in the 100 years before the housing bubble. So that one final year of liftoff, there was more housing appreciation relative to inflation than there had been in the 100 years prior to the bubble. So now we have a new discrete trend that takes place. And as I go through the analysis in the book, it's clear Fannie and Freddie, although they're continuing to participate, they're no longer growing fast enough to drive that significant acceleration of housing prices during that phase of the bubble. So what happened? This goes back to what we were talking about earlier. In 2000, the tech stock bubble collapses. There was a bubble through the late 1990s, largely built around internet mania and all these internet stocks coming public. And there were other factors taking place that contributed to it. And we had this extraordinary run-up in technology stocks that happened through the 90s, but with incredible acceleration in the very late 90s. In 2000, that gets to the point where it's no longer sustainable, and we go through this collapse in tech stocks. A collapse in the NASDAQ index, which was comparable to what happened to the broader index of stocks back in the 1930s. Not as severe from a stock market perspective, because that's, there's more to the economy than just these technology stocks, but a very significant event. The Fed responds to this collapse by going through a historic decrease in short-term interest rates, which it controls, the federal funds rate. It basically controls the short-term interest rates in the market. What they're trying to do is help offset and provide some juice, if you will, or some things that will spur economic activity that will try and offset the impact of the collapse of the tech stock bubble, so that the economy won't be so significantly impacted. The mistake that they made unwittingly, and we know it's unwittingly for a variety of reasons we can touch on if you'd like to later, but the mistake that they made was that they lowered the short-term cost of a loan, which would be an adjustable rate mortgage, an ARM mortgage, adjustable rate mortgage, a 1-year ARM mortgage. That was lowered to the point where it was below the rate of housing appreciation. And the way that finance basically works, I go through a few examples in the book, is if you get into that kind of situation, you will significantly expand the return on investment that somebody receives by investing in a home with borrowed money. So just to use a quick example, if let's say you own a home that's going up 6% a year, and if you put 20% down, and if you can borrow at 3% a year on a 1-year adjustable rate mortgage, then the 20% that you have invested in the home will be growing by 18% a year. This is the effect of leverage. What many people in finance aren't even sensitive to enough is that only works if the interest rate on the loan is below the total return on the investment that the loan is financing. So historically, interest rates, even on short-term variable rate mortgages, were above the rate of home appreciation. And most people bought with long-term fixed rate mortgages. But now all of a sudden, the Fed unwittingly creates this historically unique situation where short-term interest rates are below the rate of the previously accelerated housing appreciation that was triggered by the GSEs. And now we have this enormous incentive to take out short-term 1-year adjustable rate mortgages and finance housing with this under the expectation of these huge returns that you're going to get. And so, what we see during this period of time is an incredible increase in short-term variable rate finance. And in fact, I think the number is something like it grows like 200% over what had happened in the 4 years before is, short-term ARM rate related financing. So that's what's basically happening in the acceleration phase is housing prices are accelerating at historically high levels. Because of the tech stock collapse, the Fed pushes interest rates down, short-term rates down to historically low levels. And this creates this historically unique set of circumstances where there is an opportunity to make fast money out of housing investments that is unlike anything that has ever happened in the country. And so that drove us through the acceleration phase of the bubble, where, as I said, by the final year, basically we had a 10% rate of appreciation, which was greater than what had happened in the 100 years prior to the bubble getting kicked off.
You used two terms that I'd like some clarification on. Leverage is one, and then the difference between the variable rate mortgage and the fixed rate mortgage. I mean, I think it's one changes and the other is fixed to the term of a contract over a long period. But like, what operationally does that do for buying housing in terms of a short-term variable rate or a longer-term fixed rate? So if you can explain those two things, leverage, and then why the difference between the adjustable rate and the fixed rate is meaningful to this discussion.
Sure. So leverage is basically, simply stated, means using borrowed money. So let's just say one of us goes out and buys a $100,000 home. If we were fortunate enough to have the money, you could buy it with $100,000 of cash.
Mm-hmm.
Most people historically have not been able to do that.
Right.
And so they borrow money to buy the home. And let's just say they borrow $80,000 and they put $20,000 down, or they borrow $90,000 and put $10,000 down. Well, the borrowed money is considered leverage. It's an investment term, and it derives from the idea that under the right set of circumstances, as we talked about, it can leverage the returns on the cash investment or the equity investment that you're making in the home. So under the circumstances like this unique set of circumstances, the use of borrowed money or leverage leverages up the equity returns, so that instead of the equity returns going up at 6%, which is the rate the house is going up, it's leveraged up because we've got this low cost financing. And so the house is growing at 6, but the equity is growing at 18%. And so that's the idea of leverage. It leverages up the returns on the cash investment made in a home or a business or anything else kind of thing. So ARM versus fixed rate, or variable rate versus fixed rate. Traditionally, housing markets had been a long-term fixed rate borrowing market. That's the market that Fannie Mae and Freddie Mac play the biggest role in, because that kind of matched the ownership intention of home buyers. And most home buyers, they're not buying homes to flip them and make a quick profit. They're buying them thinking, oh, I'm going to be here 10, 20, 30, maybe the rest of my life, many, many years. So they would conventionally take out a 30-year fixed rate amortizing mortgage, which was very safe. The interest rate would be higher than on a short-term mortgage, but you didn't have the risk of having interest rates fluctuate during your ownership period of time. So the variable rate mortgage, which became very popular because so many people were drawn into the idea of making quick money on their homes in this period of time, had the potential to provide much higher returns, but also had the potential to be much riskier, because there was a chance that if inflation started pushing interest rates up, or if interest rates started moving up, then your payments were going to go up. Mm-hmm. And a home that was previously affordable under a very low adjustable rate mortgage structure might become unaffordable as interest rates and therefore the monthly payments move up on the home. And all of those things ended up happening also. I mean, what basically brought this all to an end was the Fed started normalizing interest rates in 2006. And as they pushed interest rates up, variable rate mortgage rates started moving up, and the rate of housing appreciation dropped off significantly for a year. And then in 2007, basically everything collapsed. Everything had reached a point of unsustainability. The housing index was roughly 50% higher than it had ever been in the history of the index before. We had affordability issues because so many people were taking out these short-term loans that, were marginally affordable to begin with. We had the Fed knowing that it needed to normalize its interest rate structure, or else it ran the risk of creating, building into another inflationary cycle. And all of a sudden, everything starts to collapse in 2007.
Okay, but yeah, so the variable rate mortgage, since it was so low at the time in the short term, that made it even more, an even greater incentive to buy into the market at that point, and then maybe either flip the house or just get into the market at this very low rate. So it further increases the bubble.
Yeah, it created the incentives for people to pile into the bubble at the worst possible time, unfortunately. There were people who made a lot of money in housing for a number of years there, which is always the case when a bubble develops. It was also true in the tech stock bubble for a while during the 90s until it collapsed. But eventually, a bubble by definition is something where prices deviate from some long-term historical trend, or something that is consistent with all of the market and sustainable market dynamics in a manner that is ultimately unsustainable. Mm-hmm. And that's what happened here. And then all of a sudden, as the Fed starts pushing interest rates up, all of the problem loans that have been extended at the later stages as things got worse and worse start to unravel. and we start to have a collapse of the housing bubble that then runs from 2007 for the next, and for a 5-year period of time through 2012.
Okay, I think I follow, but let's get into the causes of the pop. Was it predictable when, so the, what goes up must come down. If it's unsustainable, it won't be sustained. So at some point there is going to have to be this a return to the normal historical conditions. Was it going to be predictable when that was going to be the case? What caused the bubble to flatline and then crater?
Yeah, well, I think, it's predictable in hindsight. There were some people at the time that understood what was happening and that stayed away from it, but they were relatively few. And in the aggregate, I think you can say most of the lending community, these are the largest financial institutions in the country. They did not see this as a bubble that was going to collapse. You've got to keep in mind, all these things that we talked about, Fannie and Freddie becoming these 800-pound gorillas, this comes out in the book in hindsight. But at the time, we were still working with the lending institutions, Wall Street to a large extent, and individuals, all of whom were working with models of varying levels of sophistication or purported sophistication, but the basic underlying understanding was housing is not something that's prone to national booms and busts. And at the time, nobody was calling out Fannie and Freddie for having triggered this, and nobody was calling out the Federal Reserve for having accelerated all of this. And in fact, throughout the years of the acceleration period, the leaders of the Fed, Alan Greenspan and Ben Bernanke, argued vociferously that the Fed wasn't causing the housing bubble. And, they posited this thing called a global savings glut, which later even the Fed disavowed. But, so all I'm saying is at the major institutional level, I think at the regulator level, at the level of the Federal Reserve, and at the level of average homeowners, they're just thinking, hey, this is a great housing market. I'm making a lot of money on my housing. Nobody is really thinking about this as something that collapsed, which is almost always the case. But then what we get to is there's some point in time where something in the dynamics of the market becomes pushed so far away of sustainable fundamental factors, which here the biggest thing would be the ability of people to afford the interest payments on the loans that they had undertaken to buy homes. As interest rates come up, as payments go up, all of a sudden there's affordability problems. People begin to default. That's an initial stage, but then the rate of appreciation on homes drops off significantly also. You think here we were in 2005 with homes appreciating 10% over inflation. And then in 2006, the appreciation over inflation drops all the way down to 3%, historically a very high level, but much below what's happening. So all of a sudden the return opportunity for new investors is shrinking. And there's a sense that we might be on a trend into a collapse or a downturn in housing prices. So in addition to causing structural problems like the inability to pay a mortgage, what also happens is kind of the speculative feeding frenzy that starts to happen in the later stages of a bubble, that dies out. And then all of a sudden that buying demand vanishes. And so, you have fundamental factors and you have speculative factors, which change almost overnight. And when that happens, then you see housing prices go into, all of a sudden the shape of the curve changes dramatically. And that's basically, what started to happen in 2005 and 2006. And then in 2007, we get into prices actually declining.
Okay. Let's see, there are a lot of questions. So the interest rate goes up, which increases the payment for a homeowner. And so then they can't pay. I guess, could you explain if the price of housing, like if I buy a house, I have a mortgage, um, and then the value of my house goes down. Why does that matter with respect to, say, Fannie or Freddie, who has the mortgage debt on their balance sheet? Because it reduces the value of what I own in the home. But as long as I continue to pay off the mortgage, like the value of the mortgage doesn't change. Kind of just sucks for me. Like the value of my house is now less than it was. So if I sell it, I'm going to lose money. But as long as I hold the asset, it could maybe go back up, but I'm not losing money. It's just in theory. So what causes this larger chain reaction where the value of home prices goes down and it causes this huge financial panic? Does that question make sense? Why does
Yeah.
yeah.
Yeah, it leads us from the housing bubble into the financial panic.
Okay, good.
Exactly. It's a perfect question for the point in the discussion that we're at. So, as you said, if you can continue making your mortgage payments, then generally you're fine. But what starts to happen is people can't make their mortgage payments. And at the later stages of this bubble, buyers were trying to buy anything that they could, and they were borrowing as much money as they possibly could. And so, there were terms like nothing down loans and those kinds of things. Everything got out of whack. All of these, many people have blamed the collapse on these factors, and these factors did occur. Less than ethical lending practices to borrowers who were borrowing because they wanted to make a quick buck out of things, in some cases, not all. All of this was going on, but we have to remember, kind of like what we talked about earlier, there was an underlying reason why it was all going on. This didn't just all of a sudden happen between 2002 and 2005, magically or circumstantially. It happened because of those leading events that we talked about, because of the GSEs and then the low interest rates that were created by the Fed. So as always happens, everything spun out of control. And what we have is, as you put it, Fannie Mae and the other lending institutions, they have loans on their books that are a part of their underwriting business. As long as people don't default, then they are generally okay, as long as the value of the property exceeds the value of their loan. So let's stay with that $100,000 example, but let's go into a scenario that's a little different than the one I mentioned earlier. Let's just say that you or I were a speculative buyer at the end of this, and we bought a $100,000 home, and we were able to borrow $97,000, and we put $3,000 down. And at first we had a payment that we could barely make at a variable interest rate of 3%. But then all of a sudden that variable rate goes up to 4 or 5%, and we can't make our payment. Now, especially if we start to see the value, if we see the value of the home drop below the loan, that means we have no investment, no value in that home anymore. If we've borrowed $97,000 and the value of the $100,000 home drops down to $96,000 or $95,000, it's wiped out our investment value. Now, if we're in it for the next 20, 30 years and we can ride it out, then fine. But we've, at this point, attracted lots of speculative buyers into the marketplace. And if they're concerned that things are going to keep dropping and they're struggling to make these loan payments, then people start to question, well, why do I continue making loan payments on something that doesn't even have any value in it for me anymore?
Okay.
And so people stop making loan payments. Now, let's take it to that second stage that you mentioned. If I'm one of these major lending institutions, Fannie Mae, Freddie Mac, Citigroup, Bank of America, some of the investment banks that got involved, as long as the home is worth more than my loan, as long as the home value stays above the $97,000, then my loan is still worth $97,000. But if this bubble starts to collapse to the point where the value of the home drops below $97,000, then I have to write down the value of my asset. So my asset is the loan that I've extended to the buyer, which I'm carrying on my books at $97,000. But if the home drops below that, then let's say it goes down to, in the first year, to 96,000. I've got to write down the loan by $1,000.
And why is that? Why not? Because don't they still owe me $97,000?
Well, let's say you're the borrower.
Yeah.
And I'm the lender.
Mm-hmm.
Okay. And so you bought this home for 100,000 and I gave you 97,000.
Yeah.
Now the home, you can't make your payments, so you default. So I take the home back. I'm the lender. I take the home back effectively.
Ah, okay. Yes.
Now I'm carrying that home, my lender's investment in that home at 97,000 on my balance sheet. If the value of that home drops below 97,000, then I have to write the assets on my balance sheet down to its current market value. And this is exactly what started to happen in kind of the summer of 2007, when we started to see a couple of hedge funds, one sponsored by Bear Stearns, which is a large investment bank in the United States, another sponsored by BNP Paribas, a large banking institution in France. There were a couple of hedge funds that they had sponsored that announced significant mortgage-related write-downs on their the assets that the hedge funds owned. And then the hedge funds went bankrupt. So this was the very early stages, what I call in the book, kind of the canary in the coal mine of the financial crisis. It was the point where I think the term that I used was, I called this the awareness stage of the crisis. All of a sudden, the broader financial markets started to become aware that the housing bubble was collapsing and prices were dropping to the point where it was beginning to cause some kind of what looked at the time like isolated, narrowly focused problems in the financial markets, in these two hedge funds in particular. And so the markets, you can see it in the short-term lending markets, and you can see it in the S&P 500. I take you through the data in the book because I've tracked those weekly week by week kind of. And you can see exactly at those points, there's a turning point in the broader markets, but it's not into a high stress stage. It's just like there's an awareness. Instead of the S&P 500 index of stocks growing on kind of a regular monthly basis, which it had been, all of a sudden it takes a dip and then it rises back up, but it kind of flattens out. And so the trend that we saw in the stock markets before those problems began to emerge kind of levels out into what I call an awareness stage. And that's because these institutions, we're starting to see the early stages of write-downs from the losses on home mortgages by the lenders or by the people who own those mortgages affect the housing markets. Does that make sense?
Yeah, no, that makes sense. Or let's see if it makes sense. So if I borrow $97,000 from you, in exchange I get a house, but I'm a speculative buyer, so I only want the value of the house if it can make me a quick buck so I can flip it. And so when the value of the house goes down, I default on the loan, and you get the value, you get the home back, so you have its value in that asset. But as it continues to depreciate in value, you lose money because you gave $97,000 out, and instead you have an asset that's worth, let's say it goes down to even $60,000. So you basically lose like $40,000. So I have
yes, but let's add one more
degree
of difficulty, if you don't mind, for just a second, but I think it'll make it a little bit more clear why relatively small changes in housing values can trigger such big problems in the lending market. Lending institutions are by nature highly leveraged institutions themselves. So Fannie Mae and Freddie Mac or Citigroup or an investment bank, they are borrowing lots of money that they're using, or let's use the two of us. I'm borrowing lots of money that I'm using to extend you the $97,000 loan. So against the $97,000 loan, it would not be unusual. In fact, with respect to Fannie, Freddie, or the investment banks, or some of the commercial banks, for me to maybe have borrowed $94,000 of the loan I've made to you. So where the risk starts, this is the later stage. I mean, we started at the early stage of awareness, but what we start to see happen as this builds, beginning in the summer of 2007 and then into 2008, is what we see is now I've got this $97,000 asset, which is an investment in this home, which is dropping in value, but I owe $94,000 to my creditors, to the people who've loaned me money to finance my business. The home starts to drop and I'm taking write-downs, and all of a sudden the market starts to perceive, and this is what happened in the later part of 2007, and then especially during the early part of 2008, the market starts to realize that the collapse of this housing bubble might be severe enough that these huge lending institutions are going to see the value of their mortgage portfolios drop enough to wipe out all of the, what's called, from an accounting perspective, the equity value or the investor's value in those institutions. So now we're shifting from the homeowners going bankrupt or belly up, in layman's terms, to potentially seeing major financial institutions experience the same kind of thing if housing prices drag the value of those assets down below what they owe to their funding sources. Does that make sense?
Yes. And so this is this is getting us into the chain reaction that causes a large panic. I mean, this is incredible. It's like a classroom right now on our podcast. So thank you. Yeah, but then talk to us about the actual panic. Like, how do we get into full financial meltdown mode?
Yeah. So what we had was, we had this awareness phase in the summer of 2007. And then if we get into the fall, what starts to happen is these major financial institutions start to announce huge write-downs of their mortgage portfolios. Initially, not so much that the world was concerned about a collapse of those institutions, but big enough that their stock prices get hit. CEOs of Merrill Lynch and Citigroup get fired, longtime CEOs. They get fired and replaced. Citigroup has to go out and raise money, I think, from the Abu Dhabi Investment Fund to help shore up its cushion to absorb what's happening. And so what we start to see is the markets we move into what I call the stress phase of the crisis, where now the markets are very worried about the implications of the collapse of the housing bubble on the major financial institutions, especially the major financial institutions in the United States. We move into 2008. In the early part of 2008, January, February, a number of smaller mortgage lending institutions go bankrupt. They don't cause a collapse of the system. The system is absorbing all of this. And then we get to March, when Bear Stearns reaches the point of failure. Bear is the one that had sponsored the hedge fund that went broke in the summer of 2007. Now we see Bear Stearns itself, one of the 5 largest investment banks, basically at the point of failure in March of 2008. And what happens is the Federal Reserve steps in and provides a historic bailout of an investment banking institution. Had never happened in the history of the country before. This causes a big political reaction. Everybody hates it, except for, I think, the people at Bear Stearns and the people at JP Morgan who bought Bear Stearns under distressed circumstances. Many people see it as Wall Street fat cats getting bailed out while they're getting crushed on their home loans. Other people see it as the government becoming involved in the financial markets in a way that they hadn't been before, and becoming too involved and bailing out firms that should be, allowed to fail and that kind of thing. So there's a huge political uproar. But there's an amazing thing that happens in the markets is after that occurs, there's a little bit of a downtick, but then the markets basically stabilize and actually increase a little bit for a while, because I think we're starting to see many of the people who are providing short-term sources of capital to the major financial institutions who are being threatened by this series of events, who start to believe, yes, we can count on the Federal Reserve or some combination of the Fed and the Treasury to step in and bail out these institutions if we get into a major downturn. We move into the summer, and now all of a sudden, Fannie Mae and Freddie Mac fail. The two GSEs we talked about earlier that had kicked all this off in the first place. And once again, the government steps in a historic and unprecedented move, and they step in to bail out those institutions so that their lenders aren't forced to take major hits. So the markets are kind of working through a very uneasy period of time here. We still see levels of stress if we're following the S&P 500 or the short-term lending markets, but we're not seeing panic. This extends all the way through until September, when in mid-September, amidst this political fury and confusion and somewhat chaotic circumstances, all of a sudden, the Fed and the authorities, the other authorities at the Treasury and the Bush administration decide not to bail out Lehman Brothers. And Lehman Brothers is unexpectedly allowed to collapse. Now, this is the specific point when a highly, highly stressful situation turns into an all-out panic. And at the time, nobody knows exactly, all these things, again, in retrospect, seem more clear. But in the midst of what's going on, nobody knows exactly how far this can go or where it's going to go or what's going to take place. We see panic take place in the markets. The S&P, even though it was up a little bit, I think the immediate week after Lehman failed, or for a few days anyway, then it starts to drop precipitously to the point where by the end of the year, it's down 30%. I think in the month of October, it's down 9-10%, something like that. Huge gut-wrenching kinds of drops. The short-term lending markets, interest rates spike up, to unprecedented panic kind of levels. And we see this response from the authorities that I refer to in the book as the bailout sink. All of a sudden, in one moment, they're not willing to bail out Lehman Brothers for understandable reasons if you live through the times. I'm not trying to, cast aspersions on them. I know what that was like. I remember what that was like. But all this, 1 minute they're not willing to do that, and then the next minute they're like throwing the bailout sink at the system through a series of different measures that are designed to try and help or shore up the financial system. Then we can move into exactly what resolved the crisis, but unless you've got some other questions about that point in time.
Yeah, this part seems more straightforward. There's a political backlash against the bailouts of the GSEs and of Bear Stearns. And then that means, and the result of that is the Lehman Brothers fail, this large sort of critically important financial institution that has like an economy-wide impact. And then that causes a major problem. So in response to seeing the problem that the failure of Lehman causes, they start throwing everything to make sure that the whole system doesn't go down. Is that more or less?
That's more or less what happened. Now,
okay.
Yeah.
And then
anything else there before we go on?
Well, let's I think go on to recovery then. Is the throwing the kitchen sink at the problem, is that the recovery, or what's the recovery step?
So I think one of the other key things, like we talked about earlier, how critical it was to build out this model of what happened with housing prices so we could see this discrete turning point. I think that one of the other critical things that gets laid out in the book is the use of, by following the S&P 500 and by following the short-term interest rates, we can see clearly when the recovery occurs. And the fact of the matter is that I'm sure that the bailout sink did some good. especially with respect to some of the moves that they made to provide liquidity and support to the money market mutual fund industry, which is something that I talk about in the later stages of the book. But what we can also see by following these measures in the financial markets is the panic was not resolved by the bailout sink of response. The panic really revolved around a small number of what I call the critical financial institutions that the markets, in retrospect, we can see were clearly concerned about. And these included there were three other major investment banks left at this point in time when Lehman failed. So when Lehman failed, there had been five. Bear Stearns and Lehman Brothers have now effectively failed. Bear Stearns was failed and was sold to JP Morgan. Lehman Brothers fails and goes bankrupt. We now have Goldman Sachs, Morgan Stanley, and Merrill Lynch left. So those were three of the critical institutions. But Goldman Sachs and Morgan Stanley are in a much more solid financial position than Merrill Lynch is. So they're able to go into the private marketplace and raise significant amounts of capital. Goldman goes to Warren Buffett and sells a huge preferred stock issuance, and Morgan Stanley goes to Mitsubishi Bank in Japan and raises a huge amount of money. And the markets, okay, so that kind of takes them off the table of fear. So that leaves us with three critically endangered financial institutions, which are now Merrill Lynch, the last of the remaining investment banks, which is under contract to be sold to Bank of America. Bank of America, who at this point seems fairly solid, but is going to evolve into becoming a critical institution, and Citigroup. And these, I think, what we can see in the events that transpire from the time that Lehman failed in September through January of 2009 is that the resolution of fears about these three firms are the key to ending the panic. So in November, Citigroup gets a massive bailout package from the federal authorities. They had received a partial preliminary bailout package in October as a part of a broader group effort, which was basically a political, in my opinion, a politically designed event to hide some very politically embarrassing facts about Citigroup, one of which was that it was regulated in part by the Federal Reserve, and not only by the Fed, but by the New York branch of the Fed, which had primary responsibility for overseeing Citigroup. And if Citigroup had been allowed to fail, it would have been potentially politically catastrophic for the Fed's reputation, for the New York branch's reputation, and for one of the Citigroup board members who had been an important figure in the Clinton administration back in the 1990s. So, the authorities arranged this meeting of 9 or 10 largest institutions. They forced all of them to take some bailout financing, but what they were really trying to do was, I think, get money to Citigroup, Merrill Lynch, and maybe Bank of America. But anyway, November, Citigroup gets bailed out. Then we get into December, and Bank of America now is starting to experience meaningful problems with its own mortgages and with the mortgages of another acquisition they had made earlier in the year. And it's very concerned because Merrill Lynch's mortgage problems are getting substantially worse. So we've got two remaining institutions, Bank of America and Merrill Lynch. Bank of America is in contract to acquire Merrill Lynch, but B of A starts thinking about pulling out of the deal. There's what's called in the business a material adverse change clause in any acquisition. And they're thinking about invoking that clause to pull out of the Merrill acquisition because they're afraid that if they take on Merrill's problems along with their own, that could put their ability to survive this at risk. There's a tense meeting between Hank Paulson and Ben Bernanke from the Fed and Paulson from the Treasury. I think they basically convinced Merrill, to put it nicely, or to convince B of A that they need to go forward with this acquisition. and B of A decides to, their board approves it, and they close the acquisition on January of 2009. And then in mid-January, the federal authorities announce a bailout package for B of A, which now also has subsumed Merrill Lynch. And what you can see is almost immediately, conditions in the short-term lending markets for the first time drop back down to where they had been before Lehman failed, like within a week. And in the broader S&P 500, it takes a little bit longer, about a month and a half. But in early March, it's kind of like you can just see the markets kind of come to this resolution that, like, hey, we're through the worst of it. You know, the basic sense, I think, you never know for sure, but basically what happens is the markets come to this sense that the rest of the financial infrastructure is okay. The other institutions are okay. We've now resolved all the problems with the major firms, the critically endangered firms, and everything's going to be okay. And the S&P 500, takes off on a very strong recovery starting in March that runs through the end of the year and then continues thereafter at all. So I think, with the benefit of hindsight, we can go back and track through and see that the announcement of that final bailout package for B of A Merrill Lynch in mid-January was in fact the end of the panic stage of the crisis. And then we quickly move into a recovery thereafter.
Okay, that all makes sense. And I don't want to go on too long, and I want to talk about how lessons learned, or how to take this information and then apply it to prevent future catastrophes or near catastrophes with the stock market and the financial industry and the economy as a whole. But why are Morgan Stanley and Goldman Sachs able to get private funding, or what made them in a better position to survive on their own absent a bailout, whereas Merrill Lynch needed a bailout or needed this acquisition to take place, and Bear Stearns and Lehman either failed or would have failed absent a bailout?
Fantastic question. And that actually gets to what are the things that institutions can do to protect themselves from getting into this situation in the future, which is
perfect. Well, go ahead.
Discussed in the book, but let's go back to that question. At one level, the answer is because significant investors, Warren Buffett in one case with respect to Goldman Sachs, and Mitsubishi with respect to Morgan Stanley, they had confidence in their ability to survive. So I don't know exactly what either Buffett or Mitsubishi were thinking when they made their investment, but what we can see, the analysis that I go through in the book, is that we look at the amount of equity capital, or the inverse of that would be the amount of borrowing that they have relative to their mortgage and real estate exposure that they're carrying on the books. And when we go through that analysis, or when I go through that, what we see is they have significantly more cushion to absorb losses in the mortgage portfolio than Bear Stearns, Lehman Brothers, or Merrill Lynch had. And I think, again, I don't know exactly what the investors were thinking when they stepped up to make these significant investments to help provide them the financing to work their way through the crisis. But effectively, I think it basically comes down to that issue. These were firms that were, a better way to put it would be significantly better capitalized relative to their mortgage exposure. And just to use a quick example, I think the numbers were roughly along the lines that a 20 to 25% drop in the mortgage portfolio values at the other firms could have put them out of business. But at Morgan and Goldman, it would have taken something like a 75 to 80% drop in the value of their housing investments to wipe out the equity in the firm of those firms. So they were just significantly better capitalized than were these other remaining critical institutions, that just didn't have the capital buffer to protect themselves against, how a really severe collapse of housing prices.
Okay, so then pushing forward into the, what could we do differently this time? How does that translate to I guess what's the recommendation based on that point?
Yeah, so I think there's a couple. The starting points, the easy starting points are we should get rid of the GSEs, basically. They should be privatized or somehow put out of business, and probably through some kind of a transition period. But we ought to remove any political privileges for those institutions and either dissolve them or turn them into private institutions where they have to operate on a playing field that's level with any of the other housing parties. If we went down that path, my sense would be they also ought to be broken up into a number of smaller institutions, so they just don't have the dominant role that they had, and they don't have the political privileges. And I think ideally it would be to liquidate and remove them from the housing markets completely. That would remove what caused the bubble to take off in the first place. The second key thing would be to eliminate or significantly deter the ability of the Fed to trigger asset bubbles. And so, the Fed operates with a mission that means that, that basically says it's supposed to conduct monetary policy in a way that balances the risk of printing too much money and creating too much inflation against the risk of pushing the economy into a downturn, which causes too much unemployment. Those two things work against each other. Propping up the economy and helping employment means keeping rates low, but running rates low creates the risk of inflation, which is something that we've been concerned about throughout the life of the Fed. But it's very clear they also have the potential to create asset bubbles. They created one in this case. They contributed to the asset bubble in the tech stock blow-off that we talked about earlier. And so, at the very least, adding a third mandate, which would hold the Fed responsible for monitoring its policies and the risk that it's creating asset bubbles, would be a contribution. At an extreme level, it would be looking at things that other people have talked about, which would be dismantling the Fed completely and going back to an environment where we're operating without a Federal Reserve type system, which we did for the first 100+ years of the country's existence, basically. So those would be kind of the core things at a big policy level that we could do. There's some other things at the mutual fund level we could do also, but we haven't touched on that. So then we kind of get to like the regulator or the corporate level, and I go through a series of recommendations which basically have to do with monitoring key areas of asset exposure for the potential of bubble-like conditions, which would mean, and this could be for an investor as well, this would be monitoring housing values relative to Shiller's index of housing values, and seeing that, if prices start to deviate from the long-term historical trend in a significant way, there is a risk of one of two things happening: either a downturn like we saw when the bubble collapsed, or a very long period of time where houses just don't appreciate very much, and the index ends up, reconnecting because inflation pushes the value up to where prices have come without prices collapsing. That'd be a more mild version of a collapse, but it definitely plays into the kind of money you could expect to make from a home, and thinking about your risk of borrowing money when you're buying a home. So I think, monitoring those kinds of things, at the individual level and at the institutional level, would be a key thing. And then also that triggers up what I just talked about, which is, watching the amount of leverage that you're operating with. So if you're one of these big institutions, they relied on these, very supposedly sophisticated value at risk models that were supposed to play out all these different scenarios based on historical trends to tell them how safe their balance sheets were. But all of those models essentially failed them. And I think a much more straightforward way of looking at things is to say, we've got these mortgages on our books, which are tied to housing values. And if housing values start to deviate and we run a risk, how much of a decline in these mortgage values could we take before we wipe out the equity value? And are we capitalized at a level that would help us survive a 100-year flood kind of event? And are we capitalized as conservatively as our peer groups, as the Morgan Stanleys and the Goldman Sachs are? If we're an individual, it means, oh, hey, for lifestyle reasons, I want to buy a home right now. I know housing prices are high, and that tells me that I better put down a pretty healthy down payment, and I better be very careful about any kind of, variable rate financing or something that could change, and put me into a dangerous position in the future. If we get into an environment when interest rates rise or housing prices start coming down, that kind of thing.
Well, great. And Todd, this has been a phenomenal conversation. I've learned so much, and to viewers and listeners, I can't commend the book enough. We haven't even talked about all of the numbers and specifically, but they're all sorts of very helpful charts and graphs with specific numbers and stories and explanations. So a phenomenal job with the book, and thank you for writing it and for coming on. My last question for you is it's a technical analysis, it's objective, it's mathematically sophisticated, and it explains what happened, why it happened, the fundamentals, and how they all interact. Is there a bigger political context that you could speak to for what this means? Not just what really happened specifically with the crisis and how it was created and then recovered, but within a larger, not just time span, but sort of political context for why it matters, and kind of moving forward, what it all means. Does that question make sense?
Yeah, it makes perfect sense. I mean, I think in this country, we've gone through a couple of phases, from the founding of the country up until the Great Depression in the 1930s, which, as I mentioned, was misunderstood and mischaracterized both then and in the immediate aftermath. We operated with minimal levels of government involvement in the economic system. The Great Depression changed all of that. And since then, we've experimented with much greater levels of involvement, both from a regulatory standpoint and from the standpoint of trying to do things to make the economy work better overall and for certain segments of the economy. The GSEs, Fannie Mae and Freddie Mac, are a perfect example. These are two institutions set up to try and help low to moderate income home buyers benefit from home ownership and all the things that had traditionally gone along with that. But what we see here is the extraordinary difficulty of the real world results of those kinds of that kind of activism or those kinds of interventions working out in the long term anywhere near like what they're designed to work out like in the beginning. And so what we see here is this, catastrophic situation where something well-intentioned, ends up costing the very people that it was designed to help, billions and billions of dollars, and losses on homes that they can't afford. And people who are working in these huge financial institutions, who get fired as these firms go out of business and are laid off, or the firms are sold in a distressed sale, and large parts of the working force have to get laid off. So, I think it argues for a much more, what would be called a free market oriented approach to the marketplace than what we've had before. And I think that the other key point is it very much calls into question again the Federal Reserve as it is constituted right now. I mean, what we've learned in the last 100 years is that the Federal Reserve, which Milton Friedman and Anna Schwartz pointed out, uncovered in a fantastic book of theirs in the early 1960s called A Monetary History of the Country, they were the ones whose analysis showed that it wasn't the failure of the private markets that caused the Great Depression. It was the failure of the Federal Reserve to provide liquidity to the banking system in the midst of a panic. That was the 1930s version of what we started to see with some of these larger institutions in the financial crisis. And the Fed's failure to do the job that it was created for was really the thing that turned the Depression, a downturn, into the most severe depression that had occurred in 100 years. We fast forward to the 70s when we find the Fed monetizing the guns and butter spending that came out of LBJ's administration, and we have the worst decade of inflation and interest rates in what came to be called stagflation in the history of the country. And now we have a third critical event, which is this housing bubble. And we see that, the Fed has played, a primary causative role in each of the three major downturns or periods of economic distress in the last 100 years. So I think, from a bigger picture perspective, we have to look hard at interventions in the economy, no matter how well-intentioned, and the role of the Federal Reserve.
Well, on that note, I feel much more knowledgeable as a result of our conversation. So Todd, thank you so much. In addition to this book, 2008, What Really Happened, which is forthcoming, and we'll put a link to the pre-order in our show notes. As I mentioned in your bio, you also write on economic history. So people want to learn more from you and read more of your work, which I recommend and I'll be doing myself, where should we look?
Well, this is the first one, actually. And so I'm working on another one right now. So, but it's going to be a while before that one gets finished. So that's probably a couple of years down the road.
All right. Well, when it does, let me know and we'll have you back on Heartbeat.
That sounds great. I can't wait to join you.
Great. Thanks again, Todd.
Thank you so much.
Thank you for listening to Conservative Conversations with ISI. If you've enjoyed this episode, be sure to check out our website at isi.org/resources to see all that we offer our members, including the Intercollegiate Review, select modern age articles, debates, lectures, and of course, this podcast. Thanks again for listening. Don't forget to rate and review, and we will see you next time on Conservative Conversations with ISI.